Hey, welcome back to another video. And today we have got one that is so special. It's so long. It's so long, folks. I'm telling you, it's so long that I had to split it up into two parts, and we've got a PowerPoint presentation to go along with it. So I think I'm going to split this right down the middle in two parts. I'm just going to cut it. The first thing that we're going to do is go through the history of the tax code. We're going to talk a little bit about capitalism. We're going to talk about raising taxes. We're going to talk about just the tax code in general. And then we're going to get into some shockers. For those of you out there who do not like to watch my videos, you watch the first half of it and then you just kind of leave. I want to give you guys at least one gem right at the very beginning. So one of the interesting things that you could do to exploit the tax code or use the tax code, whatever you want to call it, is you could, let's say you wanted to go to Hawaii. You like Hawaii, and you wanted to take your family, right? So you could hire your spouse to your business. You could hire your kids to your business, and you guys could take a business trip to Hawaii, paid for by the government. Now, how do you do that? We're going to get to that in this video. So if you guys want to see all of these tricks, there are some crazy tricks in here, and there's some good history. There's some good lessons to be learned about capitalism, the tax code, and what it is, why it exists. So if that sounds good, let's go ahead and dive in. Agenda, what are we going to talk about? We are going to talk about tax incentives. Why do they give people tax incentives? We're going to talk about capitalism and the wealth of nations. We're going to talk about why do rich people pay less in taxes. We're going to talk about a brief history of the taxation in the U.S., and we're going to talk about what happens when you raise taxes. And then finally, the thing that is actually in the title, we're going to talk about the tax incentives, or in other words, how to actually pay $750 in taxes. So that is unfortunately going to be in part 2 for the most part, but we're going to get to some of that in this part, and I'll be releasing part 2 shortly thereafter. So this should be a fun video. I promise you that. This is going to be an interesting video. If you do just want to get to the tax incentives and you don't want to hear the preamble, if you will, then I will timestamp that right here. So you can just go to that timestamp. Okay, is it morally permissible to reduce your taxes as much as possible? So I have 3 counter questions to that. Do you think your money will bring about the most good with you or with the government? You got to answer that question for yourself. Who knows what is in your best interest, you or the government? And the third question is, who wrote the laws allowing for so many to avoid paying taxes to the government, and why did they write them? You have to be able to answer those 3 questions before you can say, is it morally permissible to avoid paying taxes to the government? Because if the government wrote those laws and the government wrote those laws for you to go do something, and you have your best interest in mind before better than the government, and you think that money could be better used by you than by the government, for example, in charities, which we'll get into that, then it might not be morally impermissible for you to avoid paying as much tax as possible, because then your money, your labor, in other words, your time is going towards the things that you actually care about. So that's obviously my persuasion, but other people will think that the best good that they could do is pay their taxes. They see it as a moral obligation, but I see it as a moral obligation to do the things that the government wants you to do, which is outlined in their tax code. So next slide. Rich think differently about taxes. But before I go into rich think differently about taxes, I just wanted to say that the government created the tax code to incentivize certain things and disincentivize other things. So obviously we can just look at the tax code and we can figure out what the government does not want us to do. The government does not want us to smoke. The government does not want us to drink. The government does not want us to go to jail and have to get bailed out. The government does not want us to speed. The government doesn't want us to do a lot of things. If they're charging you, they don't want you to do it. If they're giving you an incentive, they want you to do it. They want us to build housing in areas that need housing. They want us to hire certain people. They want diversity. That's what the government wants, because those are the incentives in the tax code. So rich think differently about taxes. Basically, what I wanted to say about this slide is that employees think about taxes once a year, whereas the rich think about taxes all the time. It's more a part of their plan. Like, think about a basketball game. In a basketball game, obviously you show up to the game, but before that you had weeks and weeks and weeks of practice. So the rich have access to different types of tax breaks through the things that we can do that we're going to get into that in the video, but it's basically like you've got one group of people, the employees, and some self-employed that show up to the game in April, and they just play the game, end up losing the game. And you've got another set of people that play the game. They're practicing all year round. They're practicing. And then they show up to the game. They're ready. They have all of their receipts laid out. They have all of their stuff ready, and they're ready to basically pay close to nothing in taxes. So if you look at it that way, if you look at it as someone who has an actual tax plan versus just someone who's going to essentially just get taxed at the government's whim, that is the difference between a business owner and investor and somebody who is an employee / self-employed. So rich think about taxes differently. That is that. Next thing, the tax code. So tax code is basically America's rules for the money game. So the money game is won when the government doesn't take your money, and it is lost when the government does take your money. So like we said earlier, we know exactly what the government wants us to do. As you can see here on the slide, we've got 30 pages within the 5,800 page tax code that are actually about raising taxes, and 5,770 that are about saving you money in taxes. So the tax code is huge, and most of it is about how to not pay taxes. So if you read through and understand the tax code, which I'm not going to sit here and lie and say that I have, I'm not a CPA. If you read through that, most of it is about saving taxes. So most of that saving on taxes is incentivizing people to do certain things. So then I've got over here, as with any game, there are some winners and there are some losers, but it's important to know the rules to the game. I always make this analogy on the channel, but it's almost like if you had one team playing another team. One team was about playing basketball, and they're putting up a bunch of buckets on the other team, and the other team doesn't understand why the ref keeps on taking the ball from them. And the reason why the ref keeps on taking the ball from them is because every time they get the ball, they just start running with the ball, and they don't understand what a traveling violation is. So a lot of people that are in the lower classes don't understand the tax code, so they don't understand why they're being taxed more than the rich, because the rich are reading the tax code, they're understanding the tax code, and they're knowing that it's an incentive for you to do certain activities. So that is that. Tax. What is the tax code? Why do incentives exist? So this is a little note on just capitalism, why it works in general. So why does the tax incentive exist? So it exists to essentially make the wealth of the nation prosper. So the wealth of the nation, despite what certain politicians will say to you, because politicians are trying to buy your vote, they're trying to send you a check and buy your vote. So the wealth of the nation is actually the goods and services produced. So money equals access to those goods and services. So when the government sends you a check for something that you can cash in for goods and services, they're basically saying we are going to dilute the money supply for the goods and services that already exist. When the government incentivizes, gives people tax breaks that are entrepreneurs, they're saying we're going to give you a tax break if you start a business, if you innovate, if you go make more goods and services, you make that actual pie grow. Then the whole wealth of the nation will increase as a result of your activities. So nations have scarce resources. So that's one thing that we have to consider when we're talking about why do these incentives exist, because nations have scarce resources, so we have to figure out how to allocate those in the most efficient way. So the way that we can figure out how to allocate those in the most efficient way is if we have to compete, basically, for if we have competition, basically what's going to happen is the executives at the top have to most efficiently allocate those resources so that they can get them out to the people in the cheapest way possible. So one thing that is consistently said about socialism or about controlled economies is that prices would go down because there's not all these profit-seeking capitalists in the system. But what you really see is that capitalists are they're cutting each other's throats trying to lower prices. So you actually see lower prices in capitalist systems because they have to compete with each other. There's competition all the time. There's always somebody trying to take your slice of the pie. So government incentives and disincentives are how we grow the economy. Yeah, so we went over that. Centrally planned economy. What we end up seeing there is resources are produced and distributed by a planning authority. So the planning authority essentially cannot know what everybody needs. So certain things end up getting overproduced and certain things end up getting underproduced because there's only a certain amount of resources that the country has. And when those decisions aren't being driven by the individuals, supply and demand, those resources end up being misallocated. Prices end up getting fixed through, destruction of certain resources, or just fixing prices at artificially low levels that things end up selling out, being scarce. It just doesn't work as well unless prices, supply, and demand are the driving forces. Okay, so how do we improve the conditions of the citizens? So I've got right here, investors are always willing to bet on winners if they see profit potential. So we're basically talking about investment in things like R&D, innovation, lower prices, and more efficient allocation of resources, like I was just talking about. So in capitalism, you have investors all the time that are trying to seek out profit. So if you take that profit away from them, if you take that profit potential down, investors don't just come from the US. Investors are from the US. Investors are from outside the US. If you take that profit potential down in the US, fewer goods and services will be produced in the US. Fewer jobs will be in the US, because investors will not invest in companies that want to do research and development and that want to basically make all these products in the US, because business conditions are no longer good here if you raise taxes and if you basically just ruin the incentives to invest, if you make it much more risky to invest, if you make it much less rewarding to invest, fewer people will invest. And centrally planned economy, prices are lower, and people think that prices are lower because profits are eliminated, so prices will come down. When in actuality, even if prices are artificially fixed down, there's still the matter of the fact that there are only a limited number of resources that have to be used for one purpose or another. So if you take a bunch of resources and you redirect them into another thing, then you're just going to throw off the price system, essentially. If you take you go make a bunch of potatoes, and then there's too many potatoes to be consumed, and you fix the prices for whatever reason, it just throws off the allocation of resources when things are not driven by supply and demand, or when when the government owns so much of industry that you essentially have to centrally plan the economy through government spending. You basically drive prices up on certain things that artificially are up, and they should be down because nobody is demanding those things. The next sentiment that I get often is, are capitalists greedy? Or in other words, capitalists want more profits, more things. But the thing is, if you really look at both sides, everybody's greedy. Employees want more, the self-employed want more, individuals want more, the capitalist wants more. Everybody wants more. Entrepreneurs want more, investors want higher investment returns. But that's exactly what drives capitalism. And that's exactly why we end up with a higher level of prosperity, is because investors are seeking profit, employees are trying to negotiate for wages that are as high as possible, and buyers are trying to buy for as cheap as possible. So everything gets used as efficiently as possible because everyone is looking out for their own good. And like I said before, we end up with overall prosperity because if you think about it, think about things that we take for granted. Like there are cars in every driveway. Pretty much every home has a refrigerator in it. A lot of things like we take for granted, like PCs, MacBooks, smartphones, things that we never would have had 3-4 generations ago. Those are all results of capitalism. If you look at countries that have centrally planned economies, like what China used to be before they introduced capitalism, like what Russia was, and these other socialist countries, they don't know how to allocate these resources as well as an entrepreneur can do. And there's no way to really just discount the value of an executive running the company in such a way that everything will be produced cheaply and there will be more produced for the society as a whole. So this slide talks about the socialism for the rich claim that a lot of people make, which I'm not a big fan of that either. I'm not a big fan of the money printing. I'm not a big fan of the quantitative easing that's going on, but I just wanted to talk about why executives get paid so much and what people, the general population, actually thinks about profit. So as you can see with this graph, the general population thinks that profit margins in businesses, or in other words, how much money is left over after everything gets paid, all the expenses get paid. The general public thinks it's 36%, when in reality, the total market got about a 7.9% profit margin. I think this is as of 2018. And Walmart, the ones that are so persecuted, they got a 2.1% profit margin in 2018. So people who want to tax that away, people who want to raise wages artificially, they don't understand that there's already not that much margin left. The reason why people invest is for that amount that's left. That's their profit. That's why they did the investment. If you take that and tax it away, if you take that and you get rid of it, then there's not going to be any reason to invest. When there's no reason to invest, then you go to a centrally planned economy. The government owns everything. And once the government owns everything, they don't know how to allocate the resources as well as supply and demand would on its own. And the last thing, why executives get paid so much. Executives get paid so much because you can't discount the fact that they can allocate their resources so efficiently, pay people as little as possible without getting them to leave, and just basically increase the amount of abundance for the country as a whole. They're the reasons, the executives are the reasons why we have so much in this country. The executives are the reason. If you take the executives out, for example, when you took them out, you locked up the capitalists in Russia, what you basically saw was their standard of living went way down, and they had to get those capitalists out of jail to get them to start running those plants and those farms. You had to basically get those capitalists out of jail to get them to raise the standard of living of Russia. So that is another historical example. Let's go to the next slide here. What if we were to abolish the tax incentives? So basically what this says is that it would be harder to make a profit. So when it's harder to make a profit, fewer people will invest. And also it's harder to innovate in a centrally planned economy. So the reason why we have these tax incentives are for people like Elon Musk, who recently just made the Tesla for us. And imagine him in a centrally planned economy. If he was in a centrally planned economy, he would have to ask the government if he can make an electric car. Whereas right now, as things stand, he can just make an electric car because he can compete with Ford. And I think that they're going to outcompete Ford. And if he was in a centrally planned economy, that just never would have happened. They would have said, who is this guy? They would have told him to, kind of go away or whatever. That would have been it. And in a centrally planned economy, what happens to people like the musicians, the engineers, architects? And 1984, that basically says, like, if you haven't heard of 1984, that's basically a totalitarian state where they were all driven by love for Big Brother and love for their country. So that's the only thing that you've got left when you don't have that opportunity for profit and that opportunity for capitalism to do what it's supposed to do. Okay, so a history of the income tax. So the income tax was actually not illegal before World War II. So the income tax didn't happen until after World War II. There was a lot of prosperity that happened as a result of those wars. A lot of production happened. A lot of production was in the U.S. at the time. And there was no income tax before World War II. Income taxes were levied on an income basis above basic subsistence. So essentially, if you made less than what they considered basic subsistence, you didn't pay any income tax. It was a tax for the wealthy. Beginning of government incentives. The government began to incentivize things, and basically what they saw was they saw more of those things. So these are the categories that we are going to go through. We'll probably get through about half of these, and then you guys wanted me to cut for the day, and we'll go into part 2 probably halfway through this. I'm not trying to make this any longer than about 20-minute video. So we'll go a little bit into these. Maybe let's go to business expenses, and then we'll go down to children, to investments in the next part. Okay, tax credits versus deductions. So tax credits, it subtracts from the amount of tax you owe, and then tax deductions reduces the amount of taxable income you have. So if you made $250,000 in taxable income, a deduction could, let's say a $50,000 deduction could take you down to $200,000. Whereas a tax credit, let's say that you made $100,000 and you had to pay $30,000 in taxes, the tax credit of $10,000 there would take that $30,000 that you had to pay and take it down to $20,000. So that's the difference there. Types of tax credits. So refundable is one that can result in a refund. Non-refundable cannot result in a refund, and most tax credits are non-refundable. So tax credit examples: children, education, working poor, helping out the poor, research and development, and building low-income housing. Some examples. So these are some head scratchers. This one is pretty interesting. Many low-income tax credits are available for business owners if they plan properly. So what does that mean? That basically means that if you are, let's say that you're a business owner and you make $250,000 and you're able to reduce your actual realized income based on deductions to $30,000, according to the IRS, you just made $30,000. So you are poor, depending on like how low you can get it. You can apply for things like food stamps. So depending on how you plan it, you could apply for things like the working poor credit. You could apply for you're basically reporting to the IRS that you're poor, even though you actually did these deductions through your real estate and all that stuff that we'll get into here in a second. Okay, well, yeah, we already talked about this one. Family business trips. If you hire your family and you guys have to basically talk about business, you guys have to be on a business trip. It has to be some type of business, and you guys can basically take a trip to Hawaii and do whatever you guys want to. Just some of it has to be business, and then you guys got a free trip on the government. Business expenses. What is a business expense? So these are the requirements. It has to be, the primary reason has to be to conduct business. The amount and frequency has to be customary for someone in your field. So if you're a plumber, you can't just be like jet setting all over the place and plumbing everywhere. And the business expense must be necessary. So it has to be basically related to your business. The thing is, though, that these bars are not hard to jump over. Like, as you can see here, travel, you have to, the verbiage is, it has to be mostly business, which mostly business means that 4 hours during your day is business. So essentially, you could do something like, let's say that you're a property investor. You could go see properties for 4 hours, and then for the rest of the day, you could do whatever you want to. You could send emails for 4 hours of the day, and then the rest of the day, you could do whatever you want to. Most business owners, people that are entrepreneurs, people that are really deep in their business, they're going to send emails 4 hours out of the day anyways. They're going to do something on their business 4 hours out of the day anyways. So meals, you have to talk about business. So let's say that your wife or your husband was your business partner. If you guys talk about business during your meal, pay for it with your business credit card, and that was a business meal. We just talked about that. Invest where you travel. So if you had an investment property in Hawaii or Tahiti, or you had an investment property in Cambodia, as soon as you go out there to visit that property or to check on things, well, that was a business expense. Just pay for it on your business credit card, and that was a business expense. Have meals with your business partner to discuss business. So we just talked about that one. Your wife could be your business partner. Your husband could be your business partner. That's a business expense. Children. So you get a $2,000 tax credit per child as of the last time I checked it. You can, okay, this one's pretty good. You can put your child on the payroll and take deductions from your salary. Meanwhile, they're getting taxed at a lower bracket. So essentially, gift taxes, we'll talk about that in the next part, but you can avoid gift taxes by giving your child, you put them on the payroll and you just pay your child. Let's say that they make $80,000 and they're getting taxed at, 20%, 22%. Instead of, if you were making $400,000 and you want to get yourself down to $320,000, you would essentially be able to just pay your child $80,000. And that would take your taxable income down. And then you could deduct yourself a little bit further than that with your real estate, with your other investments, and by doing things like investing in low-income housing, things of that nature. So that's interesting. You can pay your kids so that you can essentially lower your taxes because you paid them. 529 account. So 529 account or Coverdell account is a tax-free account that you can put money into for school expenses for your children or for yourself or for whoever. The only restriction on that is that you pretty much are going to be investing in the stock market. Other restriction is that you can only use it for school expenses. If you do try to take it out, you'll get hit with a penalty and the taxes if you try to take it out and just disperse it to yourself. But that is another way to avoid taxes on gains. And let's see. Basically, if you got an estate that's over $1 million, you can be paying up to 40% on estate taxes. So if you want to avoid estate taxes, there are a couple ways that you can do that. So you can gift a minority interest of your business to your kid. So basically what a minority interest is in a business is a non-controlling interest. So basically what a minority interest in a business is a non-controlling interest. So they have ownership of the profits, but they do not have control of the asset. So you could give them up to 99% in a limited partnership, you could give them up to 99% of ownership of the profits. So they have basically all the ownership, and then you could still be the general partner, which means you still control operations. You can still pay yourself a salary. So you still control the income of the asset, or whatever is inside of that business. It could be a house, rental property. It could be a business. But essentially what happens is when you die, your estate is going, basically when you are in a partnership and your partner dies, their estate will be taxed, and then you're supposed to buy out the rest of the business. So if you only own, let's say I own $1 million business and I die, my child has 99% stake in the business and I have 1%. That's going to essentially mean that my estate was taxed on $10,000. I think I did that math right, but basically that 1%, it goes into my estate, gets taxed, they buy it back, and then the 99%, the child already has it. So there you go. You can avoid some estate taxes. Discounting. So saleability discount and non-controlling discount. So those two discounts, the first one is saleability discount, is if it's hard to sell a business, for example, like a small private business, you can get a discount. You can get that discounted based on the valuation of the business. So if the business is valued at $1 million and you own, I don't know, 50% of it, you give 50% of it to your heirs or whatever, it will be discounted less than what it's actually worth, because it's kind of hard to sell half of a private business. That's the rationale there. So you can basically give them more wealth than, because it's hard to sell, you can give them more wealth than what it's actually worth. That's a way to avoid some taxes. Non-controlling discount. So essentially the discount there is because if you give somebody shares of a company that have access to the profits, but they don't actually have any influence over what goes on in the business, those are harder to sell as well, because if nobody wants to buy control of the profits of the business, but not control of the business itself. So that's another discount that you can do, is called discounting. A lot of these tax credits are only available to entrepreneurs and business people. So if you are not an entrepreneur or business person, think about doing that, because if you become an entrepreneur or business person, all of these tax benefits will be available to you. If you sit down with a tax preparer, a tax planner, they will probably be able to figure out how to get you to pay close to nothing in taxes. So how you are paid. So essentially, how you're paid really has a huge influence on what you're going to be taxed at. Dividends, for example, here are taxed a lot lower. They're taxed as passive income. If you were to leave money in your business, it's taxed at 21%, or the corporate income tax rate. And the thing under that is how Amazon was able to pay zero taxes, because reinvesting your profits means that there is no taxable income left over. So research and development, things like that. And passive losses and carry forward losses. So passive losses could be something like real estate deductions. If you did have a deduction from your real estate, but you also have some passive gain in another business, let's say that you own 10% of $100,000 that you made in another business. Your other business made $100,000, you own 10% of it. So you made $10,000, but you've got a real estate depreciation that you can apply for $10,000. You can balance those out so that you essentially say, hey, IRS, I didn't make anything because my business made $10,000, but my real estate depreciated by $10,000. So I don't have anything to give you. The other thing that is good to note about that is that if you're writing things off, they have to be like income sources. So you can't write off passive losses against active gains, for example. It has to be passive losses and passive gains. So this one's pretty self-explanatory. Passive income is taxed at a lower rate, so it could be 0, 15, or 20% depending on your tax bracket. So what counts as passive income is real estate or business income if you are not materially involved, which, as it says, that is 500 hours per year or less. So that next bullet, we already said that you can offset passive losses with passive gains and basically report no income. And the last thing is you can get paid in stock by your private company. So you can pay yourself in stock. That's going to basically make it so that is taxed at a capital gains rate instead of being taxed at your income rate. But you do have to pay yourself a reasonable salary, which a reasonable salary is just something that you would pay somebody else to do what you're doing. So a reasonable amount that you would pay for what you're doing in your business. Okay, accrual versus cash method. So cash method basically means that on the books, something is going to actually happen when cash exchanges hands, versus the accrual method, you can kind of it's supposed to be when the transaction happens. So basically the point of this is that you can be a little bit flexible. The IRS says that you can be a little bit flexible using a combination of both. So you can kind of set your own fiscal years. You can say when income happened. You can move things around a little bit so that one thing can be in one tax year and something else can be in another tax year, so that you can balance out those losses and those gains. Okay, depreciation and amortization. So we've already alluded to this. So depreciation is essentially taking an asset like real estate or something like a building, and it's got a depreciation schedule, or in other words, it goes down in value on paper by a certain amount. The government allows you to say it went down in value by a certain amount every single year. And the same thing goes for amortization. Amortization is basically something that's not tangible. It could be like a brand or something. The government is basically subsidizing that thing over time. So over time, you're going to be depreciating and amortizing things down. So that's going to be able to offset some of your income within those businesses and those real estate properties. So cost segregation is within that. So let's say that you bought a business or like a piece of real estate, and it's got certain things in it. So those individual items, you're going to be able to cost segregate. If there's something that depreciates faster than the real estate itself, you can write all of that off as soon as you buy the building. So you can essentially, and you can also carry forward those losses. Did I write that in? You can also carry forward those losses. Basically what that's going to do with the carry forward losses is, if you, let's say that you make $10,000 and you have $20,000 in depreciation, you can depreciate that by $10,000 in 1 year and then carry forward $10,000 more. So if you made $10,000 again next year, you can use those losses again, and now you have reported $0 for both years. All right, 1031 exchange. So essentially that is a like for like, either business or real estate exchange. So that is part of 1031, the section of the Internal Revenue Services tax code. So 1031 exchange, you basically buy and sell a property at the same time, and you don't have to pay taxes on the gains. So essentially, if you do all of these things which I'm about to list, you don't ever have to pay taxes on your real estate sales. So if you do 1031 exchanges, you don't have to pay sales on the taxes on the sales. Cash out refinances. So if you, instead of going and selling the property, if you just put another mortgage on the property. Let's say that I own a $300,000 house outright. If I get a $200,000 loan on it, then I basically get that money for free because it's a loan. It is not me selling the property. I still own the property and I have the money, so I can go take that and bring it somewhere else that's tax free. And the last thing that I'm going to go over for this part is the stepped up basis. So that essentially says that if you can own a property, and if you own it until the day that you die, as long as you don't sell it on the day that you die, if you were to sell it on the day you die, you're going to pay those taxes on it, whatever those taxes may or may not happen to be. Let me just take a note on that really quick. If you live in a property for at least 2 years and you don't make over $250,000 on it for individuals, or over $500,000 on it for people filing jointly, you will not pay taxes on that either. So, but anyways, the stepped up basis, if I were to die right now and my heirs were to get my property, it basically steps up the cost basis, so that if you were to, let's say that I bought it at $150 and I was going to sell it at $500, instead of them getting taxed on that $350 delta, they would just, essentially it would step up the cost basis as if they bought it that day. So there's no gains. It eliminates the gains and it can't be taxed. So anyways, hopefully you guys like this video, and I'll see you guys in part 2.